Back to another LinkedIn Live. We have got a special guest today, Kevin Day, and I did pull something up on him, but my computer's not working. He's got a lot of background in affordable housing. He's a Harvard grad, and we're going to bring him on and just ask him all kinds of questions to try to demystify the affordable housing. It's something that I've always been interested in, but I don't have a ton of knowledge on. So I'm really looking forward to this.
Absolutely.
Hey, Kevin, how are you?
Hey, everybody. I'm doing good. How are you guys doing?
Excellent. It's really glad to have you here. I know nothing about affordable housing, and I tried to do a little bit of research ahead of time, and I just felt so overwhelmed. So I'm glad you're here, and you can try to demystify this for me. It's been something that I've always been intrigued about. Why don't you start by just telling the audience how you got into real estate, and then ultimately how you got into the affordable housing sector?
Yeah, well, thanks so much for inviting me and having me on. And like you say, affordable housing is interesting and has so many wrinkles. So hopefully I can shed a little bit of light on that. But just go into my background. I actually, I was always strong in kind of math and studied physics and stuff, and got to college and was still doing that kind of thing. But then, like after my second year, I actually switched to a theater major because, the parties were a little better and the girls were cuter. And, I was 20 years old and what the hell did I know? So,
Right.
So I actually graduated with a theater major and then kicked around doing some different stuff. And eventually ended up back at grad school at Harvard. And I got a master's in public policy, which is really like studying all the government programs and the administration of those. And they had, a major in kind of, social policy or urban development stuff. That's where I really started getting interested in it. And to me, like all that stuff, it includes financial analysis, the stuff that I really liked, but it's applied, it's not just theoretical. And so, that was one thing that I found really interesting. And so coming out of grad school, I actually worked for a little while with the Boston Housing Authority. And so, I mean, one of the things about affordable housing is there's several different flavors of it. There's been a number of different programs over the decades. And so, people have different conceptions of what affordable housing is because it's a bunch of different things. And so public housing is a program that was started in like the 30s and 40s and was federally funded. And that's all the old big projects that you might see in different cities. And, some of those were designed and built pretty poorly and then not very well funded over the years, and became like huge disasters by the time that they were 50, 60 years old. And so, there's famous examples of where they were just blown up and torn down because they were really just kind of failed projects, right? So that's what some people think of as affordable housing. But then you have other things like the HUD Section 8 program, where like in the 70s and 80s, they were providing financing to build or renovate properties and subsidize the rents for the tenants. And some of those were quite successful, but some of those also ended up having problems. For both of those programs, you really had a concentration of very low income folks. And that was not always the best combo or, the best influence on the neighborhood and the environment where they were, And so, some people think, oh, affordable housing is these projects because there's still a number of those around, and is, kind of a dirty word. But then in the late 1980s, they came out with the low-income housing tax credit program. And that is a program that provides tax benefits to investors who invest in getting these projects built. And they're privately developed, privately owned, privately managed. I mean, sometimes nonprofits, but there are a lot of private developers doing this stuff. These are a lot more successful properties than some of the old stuff. And some of these are, suburban garden properties. You would never know for some of these until you walk in and they say, well, where's your paperwork for what your income is? And then you say, is this an affordable property? And these are targeted at kind of that, modest income, but not like very low income. So it's actually 60% of the area median income. So you can say, it's a little below the average income of where you are. And so those rents are then capped at a certain amount, which is, affordable to people at that income level who are paying, 35% of their income. As we've gotten more wealthy as a country and as the costs of like some of the other goods have come down, and the cost of housing does nothing but go up. And now you can see studies where people are paying 40-50% of their income towards their rent. And that's why affordable housing, now is such a big topic, because it's just the rent is too damn high. And so, we can get into, then there's more wrinkles of like, there's redeveloped public housing, which is called Hope 6. Although now they have a new program for redeveloped public housing called RAD. There's just, and that's one of the things about, like, if you're interested in affordable housing, you've got to embrace the complexity and some of the bureaucracy, right? There's definitely money to be made, but you have to be comfortable with the fact that there are a lot of requirements. It's specialized knowledge, and you're going to be working with government agencies who you have no control over, and that's kind of the downside. For those of us who don't mind beating our heads repeatedly against the wall, it's also kind of a nice outcome. You end up with this stuff that is really very needed. So I don't know. That's kind of it in a snapshot.
Do you think it's successful on the private side now because it is owned privately and the owner is more apt to keep the property up instead of kind of letting it deteriorate over time? Or
yes,
is that the big driver?
Definitely. You have lenders who have a stake. You have investors who have a stake. You have private developers who have a stake. All of that makes a difference. How it's underwritten up front to be sustainable over the long term, and then how it's taken care of. It still drives me nuts. And I've been involved with a couple of public housing agencies that have privatized their property management. There is absolutely no reason why government should be doing property management when it is done perfectly well in the private sector. They have historically done a pretty terrible job at it.
Yeah. So Kevin, I'm just I'm very familiar with affordable housing. Actually, I took a 2-week course, kind of like a crash course on affordable housing development, because we're considering.
So you learned everything.
Yeah, yeah, right. We learned enough to be I learned enough to know that it wasn't for me. But for those people out there that are not familiar with the business model, explain to us how affordable housing developers make money.
Yep. So let's talk about a new development. That's going to be probably the easiest way to think about it. So you're going to buy a piece of dirt, and you're going to put it under contract. You got to find the land, also find a seller who's going to be willing to stick with you during a pretty long process to actually close on this. So let's say you get that lined up. Then you have to put together a whole proposal, all of your design and plans and how you intend to finance this. And oftentimes you're doing an environmental review. You're doing everything, pre-development. One thing that people say about affordable housing is that it doesn't require equity because you're not putting owner equity into it, which is true, but you're putting a bunch of money into it on the pre-development side, right? And that's your risk too. But so then and that's what you take to apply to the agency. So in New York, it's the the Department of Housing and Community Renewal, HCR, that allocates the low-income housing tax credits. So you're going to apply to them for that allocation of the tax credits, and you're also going to line up an investor who's going to buy those tax credits and give you a chunk of money, because that's what fills the gap, right?
Mm-hmm.
You can't. It's just you can't make it work with those rents without getting. You got your mortgage financing, plus you need that other chunk of equity. And so, but in all of those development costs is a good chunk of developer fee, and that's what you're going to earn for doing the project. So when you get the tax credit allocation, and then you close on all the financing, you close on the purchase of the land, you got everything ready to go to start the construction. You have $1.5 million developer fee that you're going to earn. Now, the incentives are lined up like we talked about. You got to deliver that property on time, on budget, get it leased up, get all the tenants qualified before you get that $1.5 million. You'll get maybe $200,000 up front for doing everything that you did to get there, but the rest of it is backloaded pretty much, and that's the economics. Plus, then if you've structured it right, you've got ongoing cash flow from it.
So how does the cash flow? How does the cash flow come in on a project like that if you're doing new product at today's inflated cost? Like, does the cash flow come from property management fees, or does it actually come from bona fide cash flow after debt service?
Yep. You might get allowed to take a property management fee that's a little bit higher by the agencies, and that's one way to capture some of the fee. But if you've structured it right, the first lender is going to require you to have 115, a 1.2 debt service coverage. You've got to have cash flow. They want to have that cushion. Now you may have gotten some additional funds loaned to you that are going to take a chunk of that cash flow, but there will actually be some cash flow generated by the property, and that gets paid off. Now it's weird how these are structured, because the equity investor, they get those credits, they claim them over a 10-year period, and they are going to get the credits, they're going to get the depreciation. In order for them to get that, they're usually the 99.99% owner of the entity that owns the real estate. They're like, oh, that's not good. I only own 0.01%. but it's actually fine, because you end up getting 80 to 90% of all the economics off of the property, even though you're only the 0.01% owner. So you're able to do that in the documents to kind of split those between the ownership and the cash flow. And so that's how that usually works.
What about upon the sale? Do you still get a windfall when that happens as well as a developer?
You're still talking about 80, 90%. Sometimes you can carve out even a 5% sales fee. So you're getting that before anything goes to the investor. And
you're taking 80 to 90% of all the profits?
Yep.
So why would an investor invest, I guess? It sounds like they're kind of getting the short end of the stick.
So you have to think about the investor base. So the people who are investing in this are primarily banks, plus you get some from Fannie and Freddie. And these are people who have kind of a mandate or an incentive to do this kind of investment. Gotcha. And they're investing, basically their return is all on the tax credit and the depreciation. Okay. They're looking at it as a tax investment, and they're getting the yields on these things are 4.5%. just for the tax benefits that they get over this 10-year period. But they're fine with it. The default rate on these properties is 0.1%. These things are very, very safe. So for them, it's hey, I'm buying a tax advantage bond, right? Yeah. And this is Key Bank, this is Wells Fargo, this is Chase, Citibank, whatever. All those banks, they have requirements under the Community Redevelopment Act to make investments back into the community that have some sort of benefit. And so this helps their CRA score, and and that's why they do it.
Yep.
So any cash they get at the end of the day is kind of gravy.
Very cool.
Yep. So Mark, just tell your investors, same thing. Like, yeah, get 10%, you're fine.
Yeah, you're fine.
Yeah, no, I think that because like Mark and I are used to the business. A lot of other real estate investors are used to the business of you buy a property, you buy it right, you improve the property, and you whatever you get after debt service and putting away money for capital improvements, that sort of thing, is sort of like it's a cash flow type of business. Several small cash flows over time. Whereas the affordable development is like wind, sort of like windfall up front in terms of developer's fee. Maybe you get a very, very small amount of cash flow over the holding period.
Yep.
And it's kind of hard to even call it. It's not even the same like real estate business. It's a completely different business with different economic factors.
That's right. You don't have real equity coming in for like real return in some ways. I mean, it's just, that's not the business model. But it works. It actually works pretty well.
And how do you guys find the banks? They just come to you. They know that you're doing it, and you've just kind of built those relationships over time.
That's exactly right. And and then there's some that you do repeat business with. You like the way that they work. They're reasonable. And when you've done it with them a couple times, it's easier to do subsequent ones. So we have a stable of maybe 3 tax credit investors that we do most of our deals with. But the other ones would also like our business.
So if you're somebody that was just getting into this space, how would you find those key relationships at the banks? Like who?
So the problem is that over time it's become, more and more kind of sophisticated and complicated, right? I've talked to folks who back at the very beginning of the program, when nobody knew really how it worked. So this is like 1989. And they show up to the agency and they're like, yeah, I got a project I can build, can I get some credits? And they're like, sure, we got these credits. Like, we got to give them out. Now you're putting together a binder like this that has all of your pre-development work totally completed. And you'll also get points for having done this before and having managed other affordable housing properties, right? And so that puts newcomers at a disadvantage. Yeah. So 2 ways that you can get into it if you want to. If you're already doing stuff on your own, and that you're going to want to partner up with somebody who has experience, learn from them, get that experience without having to try to create it from scratch, because you're never going to do that, unfortunately. Mm-hmm. And so you're really going to have to partner with somebody and insist that they bring you along and keep you involved so that you can learn how to do it. The other way, if you're younger and you're just trying to find out what to do, go work for one of these. Get the experience that way. Either rise through that organization or eventually break off on your own. And then by that time you'll have a reputation where you can do that.
Yeah, it's great advice. How long does it take from contract to breaking ground? You said that could be, for a seller, that could be kind of a long time period. What is your due diligence period usually look like?
Not shorter than 12 months.
12 months.
I know. It's crazy. So you got to find somebody who's, wants to go along and do that. And that's not every seller.
Do you pay them like
sometimes we're getting land from the city or from people who want to see it specifically for that use.
Yeah. That makes sense. Do you give like a non-refundable deposit for like a normal typical seller that might not be inclined to go along with you?
Yes, probably. Because I'm not as involved on that end. And we talk a little bit more about what I do within Conifer. But and sometimes it's a purchase option, right? It's not necessarily under contract, but you're giving them some money for that option. That's how you tie it up. But you got to have that. If you're going to do all this work, you damn well better be able to close on your land.
What is the percentage of those that close, if you know, versus those that just kind of didn't pencil?
So, right, we'll have a due diligence period. where we can figure out if it's really going to work. And we do walk away sometimes. Of the ones that we've actually like gone hard or said we're going to do it, I mean, our success rate is very, very high. Yeah. Now, it may take us 2 or 3 years to get there, but we will do it.
That's cool.
Yeah. And so, Kevin, if you can explain, like, there's 2 types of low-income housing tax credits, right? What are those 2?
Oh, yeah. So there are 9% credits and there are 4% credits. And I don't know why I just got darker here, but oh, there we go. And so the difference between those, so the 9% is really what you need for the new build these days. Can't really make it work with 4% anymore. And 4% and 9% don't really mean anything. I mean, once you get into the calculation, they mean something. But basically, you can think of it as a 4% is covering 30% of your cost, whereas a 9% is covering about 70% of your cost. And so in today's world, you need that 70% to build new projects. And those are what they call competitive. And you're going to go to the agency, you're going to submit that big binder, and they have a scoring system, and they award amounts like that. Now, the agency wants those to go as far as possible, and they cap how much each project can get. And so that's kind of forced down the development size to like 30 to 50 units. Now, the problem with developers is that each one takes about the same amount of effort and brain damage, whether it's 30 units or 300 units, but the fee on them is going to be vastly different. And so, Conifer has actually gotten out of doing those smaller projects. So the 4% come with tax-exempt bonds that are often much less competitive, or sometimes you can just go in and get them. And you might need other funding sources, or you can use them to buy an existing property and just do renovations, which are obviously a lot less work. Mm-hmm. And like down in Maryland, we're doing projects that blend the 4% and the 9% on new developments, because they're trying to stretch them and make them go as far as possible. But we can do 150, 200 units like that, which makes it worth our while. And they make their 9% go further. So, whatever. I think, it's actually probably pretty smart.
Yeah. So like Mark, like that's like the reason why, these guys need to tie up properties for so long, is that they get, through their whole due diligence, get the whole pre-development thing done. And then they submit their applications to HCR for the competitive 9%, and they're competitive. So, and like my teacher in this class told me is like, for the 9%, it's like a butcher shop. They only have so much meat that they can give out. And so, and they're gonna want to spread it out into as many projects as possible. So they're not just gonna have one 20,000 unit apartment community that is an affordable housing development and then exhaust all those funds. They want to spread it out like throughout several different projects. So it can take a year to get up to the application point, and then if they get denied, which they sometimes get denied, I think sometimes 50% of the time they have to reapply. So they have to extend that period again. So that's why you see like that property on 90 Canal Street down this, I think it's 90 or something like that, 90 Canal Street. It's a 123 unit historic tax credit, 4% tax credit program that they went for 9% originally and got turned down. That's a $67 million project. And, that's been 5 to 6 years in development, and the developer, has had to pay operating costs for the property owner to hold on to the property. So yeah, there's like a lot of risk and like brain damage there. And that's like where, I'm a caveman, dude. Like I need to like, do like very simple things with like, minimal moving parts. And that's the reason why I decided affordable housing, business wasn't for me, just because I'm not smart like guys like Kevin and Conifer. So
Yeah, I mean, like I said, it takes a certain kind, I think, to go into it and then you're drowning in a sea of acronyms too. Like every program is like, like the QAP, it tells you like how they score the applications, and then LIHTC is what everybody calls the tax credits because it's the low income housing tax credits. And so, like, yeah, it's got to people speak their own language.
Alphabet soup.
Oh yeah, and so and then just to talk a little bit more about like what I do and what some of the other parts of our business are. I mean, I know you guys like the development deals and getting deals done, which is exciting. But like, we are vertically integrated. We develop, we build, we own, we manage. And so, that's like all those components have to work together. My position, I'm the VP of portfolio management. And so, people may have heard asset management or portfolio management within a real estate firm. Those can mean slightly different things within different organizations. For us, portfolio management is all the capital transactions and longer term asset strategies. If you think about this, Conifer has been in business for 30 plus years doing this kind of work. They've been around for a long time. That means, we have quite a few of older properties too, and they're not all gonna be able to self-finance the upkeep, and so we have a pretty significant backlog. I joined Conifer about a year and a half ago, but we've still got like over 40 projects that are 15, 20 years since they were last built or renovated, and so our job is to do a couple things. One is we're negotiating with all those tax credit investors that own 99% of our stuff to get them out. We want to own it entirely ourselves and own and control our own destiny. They actually have a fair amount of rights, but we want to like say, hey, here's a fair amount of money for your interest. Thank you very much for your investment. It's time to go our separate ways. That can be a struggle. And then sometimes working with some of these banks, is not always the easiest to deal with, a different kind of bureaucratic institution. And so we do that. We refinance our properties to help finance some of these capital needs and also pull out some of our owner equity. We've been able to monetize a good amount of the equity in our portfolio, which is always nice. And then we'll sell off stuff that just doesn't fit the Conifer portfolio anymore. It's a 28 unit property that we built or bought, 25 years ago out in some small town, and that's not our business anymore. And so we're selling off those things, and that's what our job does. It's myself and two other people on our team, and we do a lot of transactions every year. And so we are what the exact count is between investor buyouts and refis and sales. But I mean, it's probably 30 transactions and net over 25 million in proceeds to the company this year.
That is so cool. So I noticed you said that you can't self-fund some of the CapEx. How does that happen? I would assume that like during the underwriting process that you've got a budget for ongoing expenditures. Are you guys like tapping into that for other projects, or how come you're getting caught into that?
Yeah. So, I mean, when we first underwrite them, we'll make sure 10, 15 years, and they're brand, a lot of them are brand new built. They're going to be in fine shape, but when you start getting to like 18, 20 years, I mean, all your HVAC, maybe your roofs, like everything starts, kind of falling apart. Right. And this idea that like 250 a unit in replacement reserve deposits, which it's been 250 a unit for like 20 years. Like that's not realistic. I mean, how much have costs gone up? 5-10 times, Yeah. And so like, that's just not enough to fund all that stuff when it starts coming due.
Yeah. I usually use a percentage to try to alleviate that. So as rents go up, I'm capturing more to go back into the property. And I feel like hopefully the rents are aligned with the cost of goods. So for my model, that's kind of how I do it.
That's smart. Yeah, that's a good way to do it. And, we assume, 10, 12, 15 years out, we're going to be able to refinance.
Okay.
Yeah. And Mark, to add on to that, I mean, there's like certain things. I mean, yeah, we use general numbers based upon like a certain percentage of rents collected based upon, the age of the asset. But sometimes there's just like things that just are not going to fit that mold. I mean, one of the assets that Conifer has, for instance, is like Keeler Park, I think, is one of your, monster properties. And,
Yep.
How do you quantify 30 years ago, having to redo all of the, like those like, those porch things that you have on the property there that start to, and some of the stuff, like we had a property that I was involved with the development of that, there was a design fail on the HVAC that we didn't catch until 15 years later, which accelerated the degradation of all the HVAC equipment, or accelerated the wear and tear on the HVAC equipment. So it's almost like one of those things where you want to have, at least in our book, you want to have a healthy amount of cash flow to like pay for the unforeseen stuff that just like you just can't quantify it.
Yep. And yeah, I mean, design and build issues, are something that I think you learn over your lifetime, and what to watch out for and what mistakes not to repeat. But like, I mean, we have a property here in Rochester where the water lines run along the outside, just along where the balconies are, and including our hot water lines. And in the winter, especially if the unit is vacant, right? Because somebody moves out and we're turning it over, and there's no heat on, and the pipe bursts, right? I mean, and that's happened, several times. And it's just like, that was poor design, and it's not an easy fix, unfortunately.
Right. We do have a question in the comments. I think I can show it here. So this is from Kyle. Kyle, thanks for the question. Can you guys see it?
Yeah.
Not the whole thing.
Right.
Oh,
it seems to be cut short.
Yeah, you're right. Okay, let me just read it then. I'll get back up there. So Kyle is saying, sorry. We know this is needed in Rochester, for example. We're trying to convince stakeholders to invest in the communities that need it the most without them taking the profits out of those communities, city, state. How can we incentivize good behavior among investors that will also be good for everyone else who lives here?
So, I mean, this has become a bigger theme, probably over the last 10 years, where like, people have dedicated more of their savings towards ESG, which I think stands for like environmental, social, and governance. But, to some of these socially responsible investing themes. And we actually see that in some of the banks and other kind of institutional equity providers who are willing to take a little bit lower return to be able to do that. And, one of the other flavors of affordable housing that we didn't talk about is the whole notion of workforce housing, which is, right, it's not a like below average necessarily, targeted housing, but it's kind of for like the average, working class people who need to, live in the communities where they work. And so, right, I mean, it's hard to find, for smaller projects, it's harder to find capital, socially motivated capital, you might call it. But you could also approach, the town or municipality to say, hey, if we agree to keep some sort of limit on these rents, can you give us a break on our property taxes? And you can make it so that it pencils out, like that it works just as good, if not a little bit better for the owner. And it's kind of a win-win. Now, I make that sound easy, and it's completely not.
Right. Yeah, I can't imagine how you even go about starting that process. You go to city council?
So every town basically has a housing or economic development department. Go talk to them and see what, if they have some sort of program or initiative and are interested in it, then have a conversation. If they're like, yeah, that sounds like a good idea, let's think about it, then just run the other way.
It's funny.
Yeah, I mean, they're usually going to have something that's prescriptive. Unfortunately, like a lot of the suburbs, that that are around that have been, had a lot of NIMBYism or not in my backyard. They're generally, a lot of them don't have those types of pilot incentives that are custom tailored towards creation of affordable housing or even workforce housing units. And that's the thing where I think that people have gotten squeezed the most, especially in this environment, is that rents have gone way up, and you have Griffin says you're smart, Kevin. But I think you're totally right, because I've done the same thing with going to a town. They're like, we really don't, we don't know. We'll have to check with somebody on that. I mean, you're usually going to have something that's going to be baked in terms of an offering. But kind of on that and Kyle's thing about what we can do as a community and stakeholders, you want to shift gears and kind of talk about policy, Mark?
Yeah, that'd be good.
So, Kevin, I mean, I think especially New Yorkers, what's hot on, policymakers' mind and a lot of other people's mind is the governor's wish to have 800,000 new housing units created in New York State over the next 10 years. From putting an affordable housing lens on, what do you think from a policy perspective can make that easier for affordable housing developers? And also, one of the things I've seen is that, and we talked about this when we were in the green room together, is that smaller projects just aren't penciling out anymore, and it's been it's been evaporating very, very fast at an alarming rate. Because I have deals that real estate brokers send me that would be perfect for historic tax credit and 9% low income housing tax credit program, and I shop it around to my friends that are in affordable housing, like, Matt, it's just too small. I'm like, it's a 30,000 square foot building. What do you mean it's too small? That's a huge building. And it's like, well, we can probably only get maybe 30 to 35 units out of it, and we just don't have the economies of scale to do a project like that. So can you give us some flavor on maybe some recommendations from a policy perspective that we can consider as a state and also as a community to help the cause?
Yeah, I mean, so Conifer's in the same boat. Realistically, doing a 30-unit project and doing a 300-unit project takes the exact same amount of work and effort, and yet one has 10 times the amount of developer fee than the other, and so it's just really not economical. The state would award those funds, but they don't see a lot of those projects for that reason. You do see some of the nonprofits who are more, mission oriented, and they find a project that they think is important and it's smaller, and they'll spend the resources to do it. But I'd say that's what's driving the smaller projects from not being able to do it. I mean, and another thing that is, right, that the 800,000 is an ambitious goal, but doable, right? She's calculating out what they can finance, how much they can process, which is great. And they have to spread it around the state, right? Especially, Governor Hochul wants to make sure it doesn't all get sucked up by New York City, right? And that's one of the reasons too of like, oh, we've got too many applying in this geographic area, we can only do 2 of them, and so, that's one of the other things about the competition. What is hopeful at the federal level is they're talking about a change that would approximately double the amount of tax-exempt bond financing that's available to do these projects. And those are more, look, we can take an existing property that may have some affordability or may just be targeted at a level that has, lower income folks, and we can and buy it and completely renovate it. And that's often, $50,000 a unit in renovations, because you're doing, roofs and windows and kitchens and baths and everything you're taking care of it. If you have an institutional investor coming in and they're going to tie up their money for 10 to 15 years, they want to see that it's going to be in good shape for 10 to 15 years, right? So you're putting a lot of money into this. And that could help expand, what people are doing significantly if that ends up happening.
That's a good insight. What about from the standpoint of the NIMBYism that we have? Because I know that Conifer has done some mixed income projects, and when we think of mixed income, not just from a community, like not just an apartment community, but also from a community as a whole in terms of mixing incomes. You're not siloing people that are of a particular economic class all living with each other, but having those mixing of incomes that happen in terms of different socioeconomic backgrounds, that sort of thing. Her ideas were, well, we can just override, local zoning ordinances and that sort of thing. And, it seemed like the legislature did not have the stomach to do that. And also the question of like, okay, well, if we pass this, would the towns just sue us anyways, and this would be rendered unconstitutional or something like that. So what are your ideas around trying to incentivize or whatever through policy mechanism in terms of encouraging more development of workforce or affordable housing in areas that are more difficult to develop in due to those factors?
Yep. I mean, what we've seen in other states is that it often comes through a court order after, litigation that goes on for a long time that forces the towns to, be able to accommodate some of this stuff. And yeah, politically it's tricky, right? I mean, and the towns are not going to want, big projects with families and the traffic and the, drain on the schools or whatever, right? I mean, they're trying to strike a balance, which is kind of understandable. On the other hand, like, we all have a stake in making sure that this works, And so, I mean, I don't know the political solution, but obviously, I mean, more and more people, it's become a pretty high priority item in politics for people wanting, some sort of solution. I mean, I think that's probably the only way that we get, some response. And, I mean, for cities that are motivated, look, every city gets some funding from the government, from the federal government under the CDBG, the Community Development Block Grant Program. They can always put some of that towards housing. I mean, that's always been a viable use. A number of places have done it. Look, they just need to decide, hey, this is important, and we can give a little tax break, or, there's something called tax increment financing, where you can get some money up front to build it in exchange for getting a tax break over time. And, there are solutions. They're not easy. And I think for people to just continue to show up and say, look, this is important. We need to have this for our entire community, not just, making sure that we just keep the minimum lot size, and we're only building houses of a certain size and price.
Mm-hmm.
Yeah. What else does that CDBG go towards if it's not going towards housing?
I mean, it can go towards like retail, downtown redevelopment stuff. I mean, it basically comes with very few strings attached.
Okay.
So, I mean, there's plenty of need for it. Then the town has to just decide what the priorities are.
Is that doled out pretty equally, or how does the federal government decide who gets how much?
There's a formula for it. And so they award a pot of funds, and it gets divvied up by the formula. And occasionally somebody says, oh, we're going to slash this. And then every single mayor in the country stands up and says, no, we need that money. Yeah. So it's another kind of good program. It just gives towns a little bit of money to do something with.
Very cool. What do you got, Matt?
I mean, I could keep going, Mark. I mean,
keep going.
Okay. So, Mark and I talk a lot about capital raising as a subject because we're in the private real estate markets, and we partner with passive real estate investors are looking to not deal with the tenants, trash, and toilets and that sort of thing. Just want to get passive income from real estate. Now Conifer is a different beast in terms of, does it Conifer now outside the syndicating low income housing tax credits? Do you guys raise capital, or have you raised capital in the past in your career, or been involved with that function?
Yeah. So on the workforce housing side, where we're not getting, the tax credit investor, we are, working with a couple potential investors just on a straight equity basis.
Mm-hmm.
Now, again, those tend to be banks primarily because they can count it towards their CRA score, and that's like a pretty reasonable cost of funding for us. But that's a small piece of what we do. All the rest is just all this affordable housing nonsense. I've worked on, because the Opportunity Zone program was kind of interesting, and I worked with somebody to help them raise capital, and taking advantage of a federal tax benefit program, but that was a lot more flexible. And that was, sorry, folks. That was somewhat easier, although finding the right match between, you had to have somebody who had sufficient capital gain without, and it's like the real estate gain kind of already has its own program with the 1031. You wanted somebody with other capital gain from selling a business or from market investments or whatever. So that had its own wrinkles. And then, building a network just of, family and friends who sometimes have some disposable money that they want to, if you find something good and they're like, oh, if you're involved and you're doing it, yeah, and you're putting in some money, yeah, I'll do that too. Now,
yeah,
I think right, I think the challenge today, at least from what I see, right, people can put their money in the bank and get 5%, right, in a money market fund, and yet prices on real estate are still like, okay, hey, I can get you a 6% cash yield, but like it's a little risky. Like, it's not a guaranteed 5% from a bank. And like, oh, how much more attractive is that? Oh, sure, there's lots of upside, but you got to sell somebody on that. And I think that's the challenge today.
Yeah. Well, yeah, that's like the, we've had a couple different factors happening, right? We've had interest rates that have gone up, so the cost of capital has gone way up. And then the underpinnings of, your risk-free rate of return has gone up. So you have this sort of, and then you have the, bid-ask spread between what sellers are expecting to get on a property versus what an investor can be willing to pay for it based upon all those other factors. That's still there's a gap that's there. So, I remember back 3-4 years ago, we were offering out a 7% coupon to our investors, annual, paid monthly, and we were like oversubscribed on that. But that was an interest rate environment where you'd probably be getting a point, a percentage and a half on a 10-year bond. So and a 10-year bond has a lot of interest rate risk on it, right? So it's not it's not necessarily risk-free, but if you have to sell that bond before the 10-year maturity, then that's the thing. So yeah, now we have, it's getting more difficult to find deals and also keep because, we have to be competitive and looking at all capital markets in terms of what, making our offerings as attractive to our investors as possible too.
Yeah. That's the challenge, right? And then, personally, look, I'm not an economist, but like right now it feels like we're in this kind of weird pause, right? There are people who are convinced like, oh, interest rates are going to go back down and it's going to be just like it was. And then there are people who are like, well, I don't know. Bad stuff could happen and, it may not be so sunny. And I feel like, to me, it seems like both are equally possible. And so, which means you have to be prepared for both, I think,
Yeah, funny story. I was at Wegmans today. There was bread was $6 for a loaf, so I actually bought a half a loaf of bread for $3.50.
No, I joked with one of my old colleagues that we're going to see bread for $50 in our lifetimes. I think it's going to happen.
Kevin, I happen to think that that inflation is pretty structural. It's not going back down to 2% anytime soon. And right now we have the government basically fighting with itself, right? The Fed is like, oh, we're going to choke off demand so that we can get inflation down. And we have this huge deficit spending and all this like spending in the pipeline for all the infrastructure work that was passed and everything. And it's like, it's creating all this, demand that like, I mean, the Fed, I think that's where they're struggling to like get it back down. Because like and I don't see how we're not going to continue to do all this deficit spending. It's crazy.
But I mean, housing is somewhat protected, right? Because we're so undersupplied on the need. So I don't know. I don't have a crystal ball either, but my thought is I'm still bullish on real estate, even despite what's going to happen in the future.
Real estate is a great protection from inflation, right? I mean, a bond, you get that interest rate forever at that interest rate. But like real estate, revenues are always going to go up, and they should go up kind of in line with inflation, and you have that built-in protection.
Yeah. So what are your thoughts on like, we saw a spike in rental rates over the last couple of years. Is that sustainable? Do you expect that those are going to hold, continue to go up, maybe come down a little bit?
I mean, we have seen softening in some of our properties.
Yeah.
For those that were renting at or near market rents, it's definitely, we were getting crazy rents, last summer, last fall, and that's I mean, we don't see that anymore. It's a little more challenging environment, so I mean, we've definitely seen that. Now, that being said, I mean, like the for sale inventory is still like super low, and prices are still super high. I mean, people are going to continue to rent, and I think long term we're going to be fine. We just have a pause or a slowdown right now.
And for your underwriting, are you adjusting your outlook on market rents to be a little bit more conservative? Did you underwrite with these like really extreme rents that kind of happened in the last year, we'll say, or did you always stay a little bit on the conservative side?
I mean, it's different for us because our rents we get capped at our rents.
Yeah.
And then, we'll do 2.5%, 3% off of that. And we've actually been seeing, because the federal rules it's based on actual income increases. And those have been going up 5%, 7%, 8%. And that's what we've been seeing around the country. So like, it's been outperforming what we, what we did. I mean, who knows going forward?
Yeah. And if we were to see a recession, how do you think that would affect, what we do in the real estate space?
I mean, obviously it's going to impact, rents and occupancy, because people pull back. But like you said, I mean, we are undersupplied longer term. So, I mean, but the nice thing also in a recession, rates do go down. That helps. It's not fun. And sellers, they always want yesterday's prices. So We'll see. I mean, it depends how long it lasts. It depends how bad it is, and that's going to dictate how much opportunity there is, I think.
Yeah.
So Kevin, on that note, with the in terms of if you were to blend it across the entire Conifer portfolio, what would you say like the percentage AMI is based upon the different geographic regions where your properties are, meaning area median income?
Oh, so federally, the area median income for a household of 4, I think, is $79,000. So, and then that varies geographically, right? So in New York City, it's like 110 or something. And then in other places, it can be as low as like 48. And so let's try to make the math easy. On a 60,000 AMI, right? And you take 1/12 of that, which is what, 5,000 divided by 12, call it like 48. I mean, 50,000 would end up in like a $500 a unit rent of 60,000 if you were at that. So, those can be fairly low rents. I think I did that right.
Yeah, I mean, so you got to have product that's subsidized to to be at those discounts to replace. I mean, discounts to area median income that you guys deal with, but
no. Sorry. Hey, I did that math wrong. What you want to do? Sorry, take the 60,000, and then you take a 12th of that is 5,000, right? And then 30% of that, so 5,000 a month is your income. 30% of that is 1,500. So $1,500 would be your 100% of the median income, if that was your median income for the area. And then 60% of that is whatever that is, $900.
Okay.
Yeah, and it's difficult to find an apartment for a family that's going to be at that rate, especially right now. So I don't know. Is it like, do recessions typically hit families harder that are at those, like, where's like sort of the I guess the sweet spot from an AMI standpoint in terms of like, all right, in the extremely low income category that might be 30% below AMI or lower, for instance, like, is there sort of like a sweet spot from a risk management standpoint where you can say like, okay, well, generally in a recession, people that are working in this type of income level and that sort of thing are more protected in a recessionary environment?
So, I mean, our portfolio is pretty advantageous. If we're at a discount to the market, and people realize that, and we're 250 or $300 below what they would otherwise have to pay, they are highly motivated to do whatever they can to pay their rent. And so we actually, people talk about it as being recession proof to a certain extent, because we actually have less turnover and less impact during a recession, right? And even if those market rents have to come down, but we're still here, people are going to, I mean, we'll have some elevated turnover, but we're not as impacted. Now, where we have rents that are at or close to market, then we suffer too. So it really depends on the area and what our rents are.
Yeah.
But it's interesting. I was looking at some of the inventory on the for sale stuff, and the inventory has, and this is for existing housing, has like doubled from last year, but that still is like close to record lows, because we were like so far down here that even doubling, like, there's still nothing for sale. And so I think that just goes to show some of the supply issues.
Yep. We are coming up on the hour, so I don't know if you guys have any final thoughts before we log off. And I mean, Kevin, if you want to give people a way to get in contact with you, if you want them to get in contact with you, now that they know you're the expert, you might get bombarded.
Yeah. Hey, I enjoy this stuff. I enjoy talking to people who are interested in it. My information is on the Conifer website, which is coniferllc.com. You can look me up there. I'm also on LinkedIn. Probably click through whatever Mark posted if you want to see my information there. And then, hey, one other thing that I would highly recommend, and some of this stuff about like the supply, and I mean, you can look at all the construction trends and everything. There is a website, blog, whatever you call it, called calculatedriskblog.com. It's a guy named Bill McBride, and he's been doing it for, I mean, he was somebody who early on identified a lot of the issues with the housing crisis. So it's at least 15 years that he's been doing this stuff, but he just posts regularly every week, all of the economic data that comes out, all the housing data. I mean, he's fabulous. If you want, an easy, simple resource to just kind of track that stuff, I can't recommend anything higher.
Awesome. Yeah, I'll drop that in the show notes. Yeah, well, I mean, thank you so much for coming on. It was awesome that you reached out on LinkedIn. I guess you're a master networker, which is really cool, because when you popped up in my inbox, you were just like, hey, you want to grab lunch? I was like, yeah, sure, let's grab lunch. And
it's so easy. I'm actually an introvert by nature, right? I
Yeah.
mean, I actually like, I'll enjoy, curling up in a corner with a book, like some stupid science fiction book or whatever that I like to read. And but it's so easy now. I mean, it's so easy to connect people. It's so easy to reach out to people, and to talk. And my philosophy is like, right, sometimes you're reaching out because like you need something or you want something or whatever, but like, and sometimes somebody reaches out to you and you may not have anything to offer them, but you know what, have a conversation, because like you never know what you're going to learn. And I've just learned the benefits of that.
For sure.
No, 100%. My dad used to tell me, dig your well before you're thirsty. So, if there's somebody that, you have an alignment in terms of industry or values or interests that you can get to, get belly to belly with, and, with no sort of, motive or like agenda or anything like that. It's a lot easier when you do have an SOS or an ask. It's a lot easier to be able to connect with that somebody and have the probability of them returning your phone call if you've met with them before at least a few times. So
and just take a few minutes in any interaction just to chat. It's always worth it, like building those relationships. And then I asked Mark if I could grab some lunch with him, and then I showed up with like couple of my colleagues, and we had him outnumbered 3-1. But he still invited me on his podcast, so
no, it was great. The more the merrier. I'm introverted like you, but I had to push through it when I shifted into real estate. I had lost my job to a layoff, and I got into sales, not knowing anything about sales. So it really forced me to be a little bit more forward facing, and it's not something that you have to be born with. It's something that you can just do.
Yep, totally agree.
Cool. All right, Kevin.
All right. Thanks so much for having me. It's been really enjoyable. I appreciate it.
All right, thanks guys. And we will see you all next week.
All right, peace.